Hey guys, how's it going? So now we're on to episode number 2 of the ASX 0 to 100 series. Now, this next company needs very little explaining at all. We might have visited 1 to 2 or 3 of their stores that they actually have in Australia, and the network is quite vast. That company, of course, is Wesfarmers. Now, the Perth-based Wesfarmers was founded in 1914. That's a long ass time. I didn't realize that they were actually been around for that long and in operation for so long. But they're basically a conglomerate of many retailers that operate in many different sectors, and a lot of the times they don't even relate to each other, which is great for diversification, but we'll touch on that later on. Now, what I'm going to do to best understand their business model is to go over their main operations. So here we go. Their biggest earner by far is Bunnings, which makes up 2/3 of Wesfarmers' earnings, as per their earnings before tax graph here, which we can see, which is about $1.8 billion in earnings. Now, this is huge, and it makes sense with many of the items in the store not being particularly low ticket items, ranging in the hundreds. And many of these tools are actually essential items around the home, and also essential for those who are tradies or people who, do renos to flip properties. And so a lot of the things in the shops are actually essentials for people to actually make a living. But we can already see one of the biggest cons for the company at the moment being heavily reliant on Bunnings as being the biggest earner. Like, for 2/3, you're relying heavily. I mean, what happens if one season, 1 year, it takes a dip, right? You're going to take a massive dip to the earnings. But yeah, I guess in the Australian environment, you're probably not likely to get that situation, given the fact that when the government does spend money, one of the biggest spendings is within infrastructure and building new homes for homeowners to get into the market. Now, the second biggest earner is in the Kmart group, which includes Kmart, Target, and also catch.com.au, which I actually use as my mobile service. Now, I really shouldn't have to explain these businesses because we've all probably have been into a Kmart or a Target before, because Target's, the bougie version of Kmart and Big W. And Kmart's just good. Like, if you need anything generic, I go there so many times with my partner. If we need anything around the house, from some of our lights to the hand wash to the towels in the house, there's so many things that we just get from Kmart because it's just nice, cheap, and simple. But basically, the earnings that they brought in this year equates to $421 million, which is actually a 22% loss due to the loss leader in Target. Which, to be fair, I don't remember the last time anyone has told me, let's go to Target. It's always been the more expensive version of Big W or Kmart, which the quality and the variety doesn't really equate to the premium price that you're paying on those everyday goods. And as a result, in 2020, one of Wesfarmers' decisions is to actually convert some of the Target shops into Kmart to expand their Kmart network, which also owns the Anko brand, which I've really gotten into recently because, again, they just sell everything that I need, from dog things, because we just recently got a puppy, to so many other things around the household. Yeah, it's just cool. It's just really neat. Now, on to their third and probably my favorite store, which has to be Officeworks, which is the one where most of us head to for our stationery or office needs. Now, the earnings before tax is a little bit lower than the others in total. It's at $197 million with a margin of 7.1%. Now, during this year, at no surprise to anybody, there's been a sales growth of 20.4%, with a large portion of the boost with people trying to establish and maintain their learning or working spaces at home. Now, I remember in this period in particular, just having a look around at the stores and some laptops, things were just flying off the shelf or straight up just being out of stock in stores within a couple weeks. So yeah, it's been a crazy period, and which is why we've seen a growth in earnings of about 13%. So if we're having a look at retailers and the outlook for the retailer space, well, it's really uncertain, and it really depends on the economy and whether people will continue to study and work from home. So yeah, really unsure. Now, what I didn't know about Wesfarmers is that they actually have businesses that involve chemicals, energy, and fertilizers, which doesn't have too much of a positive outlook due to the impact of international commodity prices, foreign exchanges, and the competitive factors and seasonal outcomes, which we all know to be the case when it comes to resources, which is why I'm not a big fan of the resource sector, even though I will obviously cover it in the series, given a lot of those companies are within the ASX 200. So yes, with that business overview out of the way, let's get into the financials. Now, in 2020, there were a couple of big factors that has actually seen Wesfarmers better off in a financial net situation. In particular, they sold their stake in Coles for a nice cool $2 billion, which kept them, well, as you can imagine, pretty cashed up. which was not the case in the year prior if we're looking at their financial debt position. In 2019, they had a net debt position of $2.1 billion, in which they were still paying dividends in that year, which I'm personally not a fan of. Not the fact that I'm not a fan of dividends, I love dividends, but to be paying dividends when you've got that much debt on the balance sheet. Now, many have, and you could argue that they were very good in utilizing their debt, because if you had a look at their EBIT, earnings before interest and tax, from last year and this year, you could cover the interest on that debt, no problemo. But I'm personally just not a fan of having such low amounts of cash, because cash gives you that flexibility to do whatever you want. Make some more acquisitions, invest into some online platforms, pay out a little bit of dividend money if you've got all that moolah, stashed in the balance sheet. Pretty much whatever you want. Now, what cash also allows you to do is to deal with some pretty bad times, because let's say instead of going to Bunnings, there wasn't any home improvements to be done. People were still working at their workplaces, but we're just in a recession. Maybe the money wouldn't have been spent in Bunnings. It would have gone to Coles. It would have gone to some other place. Who knows? All I'm saying is that if a couple of circumstances had been different, maybe a lot of people wouldn't have been going to these retailers like Officeworks to improve their home office or, home study situation, or go to Bunnings to do a lot of these renos. And if we didn't get any more money, those first homeowner grants, wouldn't have been a lot more tradies going to buy tools and resources that they need to go build these homes. Just a couple things to consider. But that's why I really, really like balance sheets with a lot of cash. With that being said though, their retail stores are very, very steady. And again, they do sell the essentials for the Australian economy. So if you want stationery, really no better place, Officeworks. You want some home reno stuff, Masters tried to give it a go, then look what happened to Masters. Bunnings is your go-to place. You want everything else around your household, except for maybe your groceries, Kmart is the place to go. Now, based on the numbers that I've mentioned, obviously Bunnings is the big star within Wesfarmers, with 13% increase to sales. Now, Officeworks and Kmart are no slackers within their own rights, having growth of 20.4% and 5% respectively. But given the poor outlook in the potential growth in the retail space, to put it nicely, they're going to be holding off on any acquisitions and instead continue to invest in these online platforms to actually boost sales and conversions. Now, in terms of their growth, the story is very similar to Kogan. I think what's happened in this year is that a lot of people have purchased things and they've brought their purchases that they would have made next year, maybe the year following, maybe the next quarter, whatever the case may be, forward just because they needed it during this pandemic period. And a lot of these items we don't replace until a year to 2 years or maybe even 3 years later. I'm talking about chairs, tables, laptops, all of those things that we see be purchased. And it's not like you're doing a reno every other week, every other month, every 2 to 3 months. And so what's happened is these purchases have been brought forward. And so therefore we've seen a rapid amount of growth within a short period of time. And the sustainability of this is going to be, well, I doubt it's going to be there. And we've seen that within Kogan as well during the March-April period where people started to buy things online and started to go to Kogan as their, one-stop shop. They had a massive spike in growth and then that slowly has died down over time. And I imagine that's going to be the same story in terms of growth, not profit, growth, for Wesfarmers retailers, including Officeworks, Kmart, and Bunnings. I will say though, this is a rather safe and solid blue chip company to invest in. As general advice, of course, the share price has gone past its all-time highs prior to the Rona. But yes, guys, that's it for episode 2 of the ASX 0 to 100 series. Hope you guys enjoyed the video. Share it with somebody who you think might enjoy or learn something from the content. Give me a like, subscribe down there, down below. Leave me a comment, any comment. Just comment on Apple, actually. I've just got a new Apple M1 laptop. So give me an Apple down below. That's much appreciated, guys. Anyways, apart from that, catch you later. Cheers.